watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions today, Chantal Marx from FNB Wealth Investments, Schalk Louw from PSG Wealth Old Oak. Be sure to send those questions through email stockwatch@bdtv.co.za, SMS 41392, or on Twitter at Business Day TV using hashtag Stockwatch. Schalk, Chantal, appreciate the time. Let's start with what was the big geopolitical story over the weekend. Chantal, was the American bombing of Iran. It didn't perhaps turn into the market story many thought. I mean, US futures are a little bit down, oil's a little bit higher, but and I suppose in a world of uncertainty, when uncertainty happens, it maybe doesn't surprise too much. Your thoughts on response? I mean, I expected more. There's not a lot happening in markets today, sort of feeding on from it.
Yeah, absolutely. I mean, if you're looking at business news throughout the morning, the word that stood out was muted. It's a muted market response, and something that was actually expected to be quite a big deal. I mean, as I was scrolling through social media over the weekend, the FinTwitterati were basically saying we're going to see oil up by 15% this morning, and it spiked, but then moved back all the way down to the levels that we saw on Friday. And that's been kind of similar in terms of all asset classes, really. And I think what the reason for it is that it doesn't seem as if Iran is in a real position to retaliate in a very meaningful way, including placing blockages on the Strait of Hormuz, which we know is the biggest risk right now. And I think that the idea now is that this could have been kind of the worst of it in terms of the Middle Eastern conflict, or the escalation thereof, rather.
I see what you're saying, and maybe we start sort of heading down. I mean, Schalk, it is. I mean, no one wants war. I can't believe anyone would want a war, but maybe we are kind of peaking, and maybe we're just becoming a little bit jaundiced to it, and hence the more benign market response, muted, as Chantal says.
Yeah, muted, but I'm sort of going to take the flip side. I mean, it sounds like that nursery rhyme. The head bone is connected to the neck bone, the neck bone is connected to the backbone, and eventually hip bone. It just seems like this thing is escalating to all the bones in the body now, and I think that's sort of my biggest worry. I think we're sort of in limbo. Yes, I don't think we've seen the reaction today that we've sort of. There was a lot of bettings going around yesterday. I saw a nice tweet. The source was Steno Research, and they actually had a graph. I think the graph dated back to the 80s, where they took all these geopolitical events or wars, the Desert Storm and Iraq War and all those things. And usually, where the wars actually started, or where the US got involved, that was sort of the low points in markets. So the markets already anticipated all these negativity. And I couldn't help to think about, let's give you a bit of a history lesson. I mean, let's take the period 31 years between 1914 and 1945. Now, why that's significant? 1914, easy, July, that's where the World War I broke out. Ended 4 years later, but that was followed by 1918 by the Spanish flu, massive flu. Then in late 20s, 30s, we had the big recession, which became the Depression. World War II broke out, and 1945, only September 1945, it actually ended. Now that 31 period, why is it significant? Even if you took all those massive, bad, the worst of the worst could happen, you still had an S&P 500 over that period that yielded a return of 7.5% per annum. So I think the moral of the story, and just to add what Chantal has said, I mean, I just think maybe one should just be careful trying to call tops in the market, stating that this is a start of something much bigger, selling out and losing out on possible growth going forward.
Absolutely. We'll take 7.5% in US dollar. And I think to Chantal's point, FinTwit, sometimes you should sit yourselves down. Schalk, let's stay with you. The big result today, Naspers and Prosus. We saw it in the trading update. We kind of expected. Their 10 cent is doing great. OLX locally is doing lacquer. Takealot lost another 13 million, but it's down to only 13 million. But this really is still a 10 cent story, although we can see little bits perhaps starting to come through. Your take on the Naspers Prosus numbers?
I thought it was solid. It was really, really solid returns. I mean, let's look at. I'm not going to go through the details. I think it's to go through Naspers and Prosus, but in general, solid set of results. I mean, cash flow that they yield. Man, oh man, this is a money printing machine. Clearly seeing that there's a big worry. Let's call it a year or two ago about China. Clearly that worry is now subsided. When you look at the Prosus cash pile, and I think let's call it the net cash pile, we're looking at about 17 odd billion US dollars that they're sitting with. They did this Just Eats acquisition earlier this year. 2 acquisitions, that's about 7 billion. So they're still sitting with a net cash pile of about 12 US billion dollars. I mean, that's just massive. Dividends doubled up 10 euro cents to 20 euro cents. I thought it was a pretty solid set of results. And still, the companies are trading way. I mean, discount to NAVs is anything between, if you take Naspers or Prosus, looking at 32 to 38% discounts to NAV. No wonder, Naspers are buying back shares. So it's, I thought solid.
Chantal, solid. And Bob van Dijk, he was there to unlock the discount to 10 cent. He hasn't done that, but to be clear, this is a nice looking chart from bottom left to top right.
Yes, absolutely. I think Bob van Dijk kind of left at exactly the point where some of the fruits of his labor were starting to materialize. And but I do like the new CEO as well. I think that in the time that he's been there, there's really been a shift in focus from being an investment holding company to being an operator. Some of the acquisitions that's taking place, some of the portfolio management that's taking place within the existing portfolio. What's really helped this set of numbers specifically is that e-commerce business and a lot of work being done in that e-commerce business finally coming to fruition. It's profitable, it's generating a significant amount of cash flow. And just kind of a last point on Prosus Naspers. Prosus doubled its dividend, which tells us that the company is confident that this cash generation trajectory will persist at least over the medium term. And I mean, I think there's a lot to like out of these numbers, and the share price reaction kind of says it all.
Yeah, I Prosus at all-time highs. Naspers just at those all-time highs, I suppose we should if we're being polite. Chantal, let's stay with you. Question coming through. Afrimat, we're seeing a serious sell-off. Understand it's iron ore, understand it's Lafarge, but surely at these levels it starts to offer value. Chantal, I mean, if anyone can do a turnaround and fix up something, it's Andries van Heerden and his team. Always going to be risks there. Your view on Afrimat?
Yeah, I mean, so the last 12 months, to the last reporting period really was very tough for the company. It was kind of a confluence of events that resulted in them releasing very, very soft results. Lower iron ore prices, an issue with ArcelorMittal SA with the blast furnace freeze. So really demand for their product coming under pressure domestically as well. The integration of Lafarge being quite difficult and tricky to navigate. At the same time, elevated debt levels because of the acquisition of Lafarge. So all of these things happened in the last financial year. I think that the way that management has positioned, especially the Lafarge story, is that most of the issues that they were facing initially are behind them. The business is fully integrated. I think we're going into a growth area for any kind of construction materials business in South Africa for the next 10 years, at least, with our infrastructure build-out plans. And they should benefit from that. In terms of the iron ore business, it's always going to be cyclical, but generally what tends to happen with this business is when everything else is under pressure, iron ore kind of comes through for them. It just didn't happen in the last financial year. But I think they're well diversified. They're very strong operators. I'm certainly getting involved at the moment. I think that the stock is super cheap. It's pricing in a perpetuation of the conditions that we saw last year, and I just don't see that happening going forward.
Yeah, and iron ore back at 100. I mean, it's been falling all year, but that does seem to be a level for iron ore. Schalk, Afrimat, I mean, my rule was quite simple. Below 50, you buy it. It is, well, it's now quite well below 50, but it also at 3-year lows. Would you be looking at Afrimat at these prices?
I mean, you started it off, great management. I mean, that's it's one of those companies which we, over the years, you've had these quality companies. I call it the ones that got away from me. It's the Clicks, it's the Capitec, it's those type of companies which we kept on referring to company that's got great results, tend to be trading at higher multiples, but really just kept on producing. Now Afrimat was one of those companies, and still is. I think they've made a few serious acquisitions. The iron ore was a biggie. I know that the construction materials, that's also like, aka the cement business, that's also been part of that transactions, and that did have a bit of a, let's call it a bit of a hiccup year or two. Multiples they're currently trading, we're looking forward PE multiples, 13 times, which is not necessarily on the expensive side, but also not just screaming by cheap. But Afrimat has never been a cheap company, and I think to its own standards might be on the cheaper side. I want to see some operational improvement in the next financial year before I would get involved. But again, one of those companies that I just love, and I do think that they will put it through eventually.
Yeah, and that multiple, if depending on operational efficiencies, could unwind. Schalk, we've got a minute and a bit before break. Goldrush, the question is, with the lotto win worth a punt? There's all sorts of news today around some of the co-winners. Goldrush, I mean, a lotto is licensed to print money, but I don't know, court cases is what I'm concerned about.
Not one that I'm holding, and I don't want to give you a few puns on betting on this stock, but I mean it's a nice well, let's call it a nice allocation they got. The National Lottery they've been doing fairly well on the sports betting side and these slots. So one can argue that they deserved winners of this let's call it this award, this license award. Like I said, not one that I'm holding. Definitely not one I'm holding currently.
Yeah, Chantal, before break, I mean, part of the problem is wide spreads. I see the spread slightly improved now, but I mean, you've got to cross a canyon to get that stock, and that always bothers me. And I can see from the chart it's run a whole lot already, I imagine, on news of that lotto license.
Yeah, I mean, 3 reasons not to hold the stock. So the first one being spreads and liquidity. You're going to struggle to sell it if you ever want to sell it. The second, you're probably going to struggle to buy it as well.
Yeah.
The second thing is you've got one large client that is extremely concentrated in terms of your revenue diversification, and it opens you up to all kinds of risk. And then the third one was what you mentioned. There's still legal risk. There's substantial legal risk in them holding on to that one big client. So just from a longer term investment perspective, I probably will stay away, and I could be wrong, but in this case, I really don't mind if I am.
Yeah, no, we're often wrong, and that's just part of what we do here. If we were never wrong, we would be on an island somewhere. Let's get to some more of the questions coming through. Chantal, question around the smaller food producers, a Rhodes Food Group, a Lipstar, a Rainbow. We talk often, certainly we've seen the Premier, really good numbers. We've seen a really good turnaround and operational efficiencies at Tiger Brands. The 3 smaller ones, is there anything there that interests you in any of them?
Yeah, I actually like all 3. So if we're talking pure food producers, it'll be RCL, Lipstar, and RFG in the smaller space. I think all of those companies have done a lot in terms of bettering their portfolios and positioning themselves quite well. They've traded very low multiples, and I think that they are very well run. There's a space for each of these companies in the South African space. So yeah, I like all 3.
Schalk?
Yeah, I would say I'm going to look at the results actually. What came through, and there was a general trend in all of them. So firstly, I think Tiger Brands definitely back on track again. That looked really good. I mean, Premier Foods, but I think the general theme is all these companies really managed to contain their costs. They mentioned that the food inflation. They've mentioned how they focus. Let's call it over this past 12 to 18 months on containing, keeping the cost as low as possible, and that has yielded great returns for them. So yeah, like Chantal mentioned, definitely trading at attractive multiples, and going in the environment that we're currently in, geopolitical unrest, we tend to think that this is one of these, let's call it more defensives. Your food producers, your tobacco companies, your alcohol companies like the Anheuser-Busch and those companies. So yeah, definitely like them.
Let's move to We Buy Cars. It did nicely. It doubled from that unbundling at a transaction capital. The last week or so, it's absolutely run. Schalk, the question is, it's starting to look expensive after last week's run. Should I just stay in or should I take some profits?
You're asking me. I mean, I just mentioned you the ones that got away. I think the forecast listing price, it opened up 1 or 2 rand higher than what was forecasted listing price. So from the get-go, I was thinking it's sort of an expensive call. And we went into this call it the declining interest rate environment again now recently, and the forecast is we might decrease even further. That could be good, for the likes of the We Buy Cars. Multiples definitely on the expensive side, but again, don't listen to me. It's just one of those companies that will most probably keep on being expensive. It's just, like I said, the one that got away for me.
Okay, so it's the pain point. I will note that for future. Chantal, I missed it because I wanted to see a clean set of results, and by the time that came out, the stock had doubled. We Buy Cars at 57 rand at the moment.
Yeah, it's a stock that I really like. I think that there's a really good fundamental case to be made for that business. I think that they're executing exceptionally well, and I think that the market that they're operating in is still extremely fragmented. And because of the trust deficit in the used vehicle space, these guys, I think, have the potential to continue to do very well in South Africa. They are meeting all their targets in terms of the parking bays that they have available, in terms of the cars that they turn and sell every single month. So, yeah, I still like them longer term. It is looking a little bit on the toppish side. I would say it's quite expensive to buy at the moment. If you're a very long-term investor, I think that it'll grow into its valuation eventually. But I think there could be better opportunities. So in any sort of weakness, I would say I would relook at it at around $50, and then I would be a definite buyer at about $45.
Can we get it back to the 25 when I first passed on it? Chantal, let's stay with you. Let's stay with Boxer. The question is, this has been a modest listing. Okay, it came in at the low 50s rather, trading at 66. Is there still opportunity here? Is there still upside over the medium term for Boxer?
Yeah, the stock listed at fair value, and I think that's why you didn't really see it react as much. We also had consumer stocks generally in South Africa under quite a bit of pressure, particularly year to date. If you look at the performance of Shoprite, for example, it would also not have shot the lights out since that Boxer listing date. So there's been a little bit of pressure, I think, perhaps unfairly so. So I think that there's an opportunity in most consumer stocks in South Africa at the moment, and I reckon Boxer is one of them. What I would say, though, is I think that the better entry point into Boxer is actually Pick and Pay. Generally, I don't like these holding company structures, but the rest of the Pick and Pay business is basically valued at zero. Yeah. So you're getting everything for free, and then you're getting that 65% shareholding in Boxer as well.
Yeah, and Pick and Pay, they've pushed out the Sean Summers' term. It's going to take longer to turn around, but he's got the cash pile and he's probably got the skills. Schalk, Boxer, will you also be a Pick and Payer?
Yeah, I think like Chantal said, there's quite a bit of hype at the time of the listing. So naturally, the share price listed at I don't want to say a premium, but it dipped on the upper side of the price range. As we sit here, the analysts are not the biggest bulls on the upside, looking at about 8% growth. When you look at the forward PE ratios compared to the likes of a Shoprite, you're looking at very similar valuations. So I would most probably be inclined to say, well, at similar valuations, at a little bit of weakness, I would most probably go, for the trial and tested Shoprite, go the Shoprite route, because get a similar type of exposure.
Yeah, okay. So we got a Pick and Pay, we got a Shoprite. Schalk, let's stay with you. Question coming through around Brait, looking at a value unlock here. Virgin looked fairly good. Premier was good, and then New Look, which is a minute part of the portfolio, looked terrible. I think New Look's a percentage point or two. Is there value in Brait, particularly seen as, at some point we're going to get the Virgin Active come to market, and what I'd completely forgotten, Virgin Active is not just South Africa, it's also Italy and UK.
What is it? Eddie Songo, eat that body beat, boy. People went into COVID and they just stopped gymming at all, in totality. And you can clearly see them. And I think the growth is something like 8% on the members this year for Virgin. You can see that they are grooming Virgin for a separate listing. When they will do that, we most probably don't know. But it's a big portion. I mean, look at close to, let's call it 2/3, 63% of the company. Then the 32% Premier Group, which we just mentioned, did really well, and seems to be on the right track. Nuclear, we're not even going to spend time. I think it's 2 or 3% of the total NAV, so it's not really going to make a difference. So as we sit here, I'm actually going to be fascinated. It's going to be interesting to look at Brait when it's actually got a listing of Virgin, if that happens, listing of Virgin, because then pretty much let's call it 95% of the company will have separate listings, which would make the NAV story quite interesting, very interesting. I think that the discount to the NAV is currently trading around about the 30% levels, which one can argue is a little bit on the wide side, but we just mentioned. I mean, Naspers trading at a 33 discount, Prosus 38% discount. Remgro still trading at a way larger discount to that. So, yeah, I think maybe priced in on the other side, but again, not one that I'm holding, but could be an attractive story.
Yeah, I mean, and certainly we've seen over the last, 4, 5, so years, those holding company discounts have gone wider generally across the market. Chantal, Brait for you for some exposure to Virgin Active?
Yeah, I wouldn't buy Brait for the Virgin Active exposure. I'll buy Brait because it's at that 30% discount, and the stated intent of that management team is to wind up the structure. So if they are able to list Virgin Active in 26 or 2027, you're effectively putting them in a position to basically wind it up. Shareholders will, if in the current environment, they'll probably receive Virgin Active shares, they'll receive Premier shares, and then the company will cease to exist, basically removing the holding company discount. The risk, however, is that you still have a very indebted balance sheet, and you've got New Look that's kind of hovering about, and you need to do something to get rid of it before I think it becomes really attractive. So there's execution risk in that wind up of the structure that's going to take place. And I guess if you look at 30% upside, let's say over the next 2 years, it doesn't look that great relative to other opportunities in the market. So I guess it depends on what type of an investor you are. I think that there's a more than even chance that you'll get your 30%. But yeah, I mean, I'll just wait for the Virgin listing. I really like Premier as a direct holding as well. I think I can do better over the next 2.5 years.
Okay.
Than the 30% in Brait.
Okay, well, then you kick the door open. Let's go to some stock picks. Chantal, Altron.
Yes, so I had a look at what stocks on the JSE are oversold on the 14-day RSI, and Altron stood out, and I hadn't actually looked at the share for a few weeks. After they released results a few weeks ago, the share price really popped. They delivered excellent results, showing very strong growth in Netstar, the fintech business and the health tech business. And I don't understand why the share price has been under this much pressure since. It's now trading at around the 20 Rand mark. I see directors were still buying at 24 Rand. The share is trading on a forward PE below 10 times, forward dividend yield that looks really attractive as well. Their cash generation is very strong. The dividend is very high, and it's growing. The prospect for growth in all their businesses are very exciting. And I mean, I would implore on investors that are interested in Altron to actually go and look at the last results presentation, where they give a detailed view of the strategy of that business and how future focused they are. So yeah, Altron.
Yeah, I hadn't looked at the chart. So it's quite rough. You make good numbers, and the market rewards you by selling your stock. Schalk, we've got a minute and a half. You're going with Total Energies.
Yeah, I had Sasol last week, and keep on making the trend, my friend. So it's an offshore listed company, Paris, also New York Stock Exchange in the US. So I think just for the current environment, we've seen the oil price kick up. There is lots of geopolitical unrest, and this is just one of these companies that I think could be a very nice hedge against things escalating any further. And it's not an expensive company. I mean, as we sit here, even after the recent movement, it's still trading at just over 10 times price earnings ratio, 6% dividend yield. So it's a company that's singing the right songs. I mean, they're talking about 50% of the capital expenditure is going to be towards low carbon energy by 2030, and they want to try and achieve net zero emissions by 2050. So yeah, looking good. Definitely total this week.
Okay, no, Total Energies and Altron. We'll leave it there for today. That's Stockwatch. Thanks to our guests, Chantal Marx, FNB Wealth and Investments. She going with Altron. Schalk Louw from PSG Old Oak. He going with Total Energies. Up next, the close. Stay watching.